We start with, hey, welcome to Spin Out, winner Dave. And we kind
I'm
of,
winner. And we're here to demystify venture, minimizing FOMO for VC through the relationship between GPs and LPs.
And in this series specifically, we're focusing on how LPs assess GPs and how you can differentiate yourself. Now, last episode, we dove into how LPs assess GPs' track record and investment strategy during the due diligence process.
And today we're going to be diving into legal terms, fund formation, and everything you talk to your legal counsel about, which is important for new emerging managers who have a lot of questions about standard legal terms. And LPs will pass on your fund if your terms are too far off market. So the terms discussion is very important. It's a very important part of the overall assessment of the GP and the operational due diligence process. So before getting too far along here, let's do a quick overview of the series, what we've covered, and then we'll dive into today's episode.
Right. So as you mentioned, Winter, this series is about operational due diligence. And we've taken a very common form of going through this process, the due diligence questionnaire, and broken it up into sections. And each section is an episode. So we've already covered things like how to build a team, what LPs assess in your team, how to make sure that team is aligned economically and structurally through the documents and through the agreements to make sure everyone's working towards the same outcomes. And then how LPs will assess your track record, investment strategy, and process. So we've got a couple more episodes left. We're going to cover fund formation and terminology today, but stay tuned in the future. We're going to go through risk management and governance, compliance and regulatory issues, as well as accounting and administration that does matter to LPs, their due diligence teams, and to helping deals actually get across the finish line.
Yeah, so I think for today's discussion, we should take the perspective of a GP and bucket the ways to think about this particular topic. We're going to break this into 5 categories. I'll lay out the categories to start, and then we're going to dive into each of the categories respectively. So the first category, which is obvious, is going to be legal, right? Like as simple as of a question as who's your lawyer? We're going to dive into that shortly. The second perspective is the entity, right? So think of it as like an LP, a limited partner, is evaluating your jurisdiction or what entity are they actually investing into, right? Which is part of the fund formation process. The third bucket will be structural, right? So this is going to be a big decision to make on terms of like what is the actual structure of your fund. And we'll dive deeper into that in a second. And then the last 2 are going to be economic terms. You can almost put this as number 1 in terms of priority, but right, as simple of a thing as like, how much are you charging LPs to come into your fund, right? Very important, needs to be disclosed, needs to be understood by the GP and needs to be, understood by the LP as well. And then lastly, I think, we call this the catch-all bucket or perspective, but other terms, right? From the legal point of view, I'm a GP. What question should I be asking myself? How should I be thinking about just like the legal perspective here?
Yeah, I think one important aspect to understand when you're starting a venture fund, if it's your first one, is not all legal counselors are the same. Not all closed-in private equity type funds are the same. And having a good lawyer in a firm that's reputable in the marketplace that does lots of deals like yours and has a good sense for what are the market terms that are currently being negotiated amongst LPs, I think it's critical that you make sure your lawyer actually knows what it is they're doing in your specific type of fund. And in this case, emerging venture fund, there are a number of great firms, both high-end, coastal tier 1 law firms, as well as great value law firms in the middle that can do this kind of work. So I think, yeah, you definitely want to make sure you have someone that specifically works in venture fund formation.
Yeah, I think that's a good point. So from the legal perspective, understanding who your lawyer is, like the actual person, who your law firm is, the reputation of that law firm, are they known, if you're a VC fund, are they known for being, in VC fund formation? And then another thing to think about is the actual, legalese, the legal language that's drafted into your documents. If it's a well-known law firm that's understood to be a VC fund formation law firm, that's an easier lift for an LP that already knows that language than a law firm that's not as well known, right? So again, I think it's a very simple perspective here, but it is important in the beginning to really understand. Again, ask yourself the simple questions, partner with the right kind of lawyer and law firm.
Yeah, and I think it's critical when you're interviewing different legal firms and partners, if you know who your potential LP base will be, or even more specifically an anchor LP, you can find a legal partner who has negotiated with them before or similar, who understands what your potential LPs are interested in. And all of that insight has second and third order benefits. It can help speed up side letter negotiations. It can reduce the amount of back and forth, both on the individual LPA and side letter negotiations. That can save time and money. And so making sure that your counsel is well versed in those arts is incredibly important too.
Let's move on to the entity point of view. So I mentioned jurisdiction in the intro, but Dave, walk us through. I'm a GP. What should I be thinking about when I'm setting up my entity?
As not your legal counsel, this is what I normally see when I have this conversation with GPs and their legal counsels. And so there's often a series of triage questions. What type of LPs do you plan to have? Are they all US based? Do you have some that are international? That's a critical first decision point, because you will set up either an entity very simple in Delaware, or you may go down the path of creating international entities, what we call maybe blockers or feeder funds. And then that can cause additional cost. It can require a certain type of fund formation attorney that may have exposure or experience there. Usually the very large firms can handle that very easily. But there's definitely first a set of considerations, right? Where will your LPs be based? Where will you primarily invest? And what size of a vehicle are you planning to raise? Because the smaller the size of the vehicle, the less you should be willing to take on excess legal cost for things like international blockers and feeder funds. And so I think all of that kind of figures into kind of that first phase of consideration with your fund formation attorney and your CFO or accountant to help think through where are you going to invest, who's going to be with you, and what are the kind of implications for those types of investors.
I heard cost in there. It's a super important, factor when you're setting up and where you're setting up. The other piece, even for international funds, right? Depending on where you set up, it can affect how you fundraise. Again, how the reputation of your jurisdiction, so to speak. If you're set up in a country or a jurisdiction that's less well known and less understood, that may make the fundraising harder than if you're set up into a well-established jurisdiction. So again, things to think about when you're setting up your entity.
You have your GP and LP entities, but you also have your management company. And I've seen some instances where people don't set this other entity up as well structurally at first. And so what I see as a very common setup structure in the US is you may have a management company that's registered in the state that you operate in, whether that's California or Texas or New York. That's important for your employees and for a number of other things. So you want to make sure you're considering that as well. And then you have the GP and the LP entity, which are very often registered in Delaware, which is what a lot of attorneys would recommend right now. And so you might have multiple states and multiple different setups for different types of entities that support the overall firm.
Let's move on. So the third bucket here that we're talking about today is the structural point of view. So what are you actually setting up? What will your fund be as a structure?
Yeah, I think generally in the US, most of the firms that you and I bump up against are set up in a very kind of similar fashion. And to what I might call the default setups, or just kind of the kind of assumptive setup. And that's a very standard GP LP structure. Now, there are other types of structures that people set up. The most common one I think people run into is the master series, or you might hear it called a rolling fund or an evergreen fund. The AngelList produces a lot of master series LLCs that support their managers that are building lots of SPVs. So it's a very efficient way from a compliance and administrative overhead perspective to do things like that. But you also have different investment strategies. So if you're not just doing a standard kind of pre-seed seed venture fund, I see often a lot of what I would call mixed investing types. So some amount of direct investing, like a traditional venture fund, but also some amount of fund of funds investing. So they're not necessarily just a fund of funds investor, but they kind of are a hybrid between direct and fund of fund investing. So I think there are a number of new strategies, and you just want to make sure that structurally your LPA and the legal terms kind of match how you're set up. And we can kind of talk through maybe the second or third order operational processes that can kind of catch you out if you're not structurally aligned between your documents and what you're actually trying to do in the real world.
The venture world seems to be increasingly complex, right? So understanding your investment strategy is step number one, and choosing a fund structure that makes sense for that strategy is step number two. I think we've heard it for years where a lot of well-known VCs will say your fund size is your strategy. And again, I think the perspective we're trying to share today is your structure is your strategy.
Yeah, and I think, I mean, even to the point of being an exempt reporting advisor versus a registered independent advisor, if you're an ERA, which many venture funds like to start out that way and try to maintain, that can restrict which types of investments you're able to do and in the sequencing of them, right? And so if you want to operate under that exempt reporting advisor exception, then you need to make sure your first few investments are qualifying. They can't be crypto or tokens. They can't be into an SPV or a fund of funds vehicle where your first investments are not principally qualifying venture capital investments. So you need to think through the structure of how you set up will impact, your actual investing day to day. There's lots of different things like that. The other big one that I see people run into is reporting timelines, and that your principal investors may be audited. They may have reporting timelines that they operate on. You, as an intermediary doing some direct investments or some fund of funds investments, need to make sure that you're able to collect up the information, do your valuations and reporting, and report out to your LPs in a nice organized manner. And that if you don't have those timelines correctly laid out structurally in your documents, you're just going to have all kinds of headaches and unhappy LPs. And so there's lots of different components within your documents that need to be structurally aligned to the real world.
All right, the fun bucket, the economic terms, the economic point of view, right? From my LP perspective, this is a sensitive bucket, maybe the most sensitive bucket in terms of where LPs could actually pass on your fund or get hung up in the operational due diligence process if they don't fully understand these terms. So, Dave, walk us through a couple of these terms. What are we talking about? And I'll overlay kind of the LP perspective on some of these.
To your point of why this has so much focus is often these are very quantitative, measures, things that can be easily compared. One fund's a 2% management fee versus a 2.5% management fee. It's easier for people to kind of assess those numbers. So I get why a lot of LPs and advisors that help people diligence funds focus on these areas. So I think the big ones that we always talk about initially, especially when you're in the term sheet phase of building out your LPA, is management fee. And I think there's a lot of different ways we could probably take these each individually, but with management fee, I see a lot of folks considering a couple different options. One, can they front load some of their management fee to get business operations going, to hire people, but pull some of that management fee forward? It's an accounting change. It's not a quicker or difference in contributions necessarily, but it's management fee is quicker. Management fee is above or below 2%. Generally, and then how is the management fee used? Is it a portion of a cashless contribution? Those are usually the first 3 or so decisions that I see GPs walking through with their legal counsel or with an anchor LP.
I think most institutional LPs agree that there should be, again, a market level of fees, right? Like that's what sustains the business. I think as well, most institutional LPs care more about long-term orientation, meaning like the carry that's set. Sometimes, I'd say more than sometimes in this market, there seems to be step-ups, which historically weren't as popular, and historically were places where LPs would pass on funds, right? Like if you had a 20% stepping up to 30% at 3x or something, like that would be, kind of an opportunity for an LP to quickly pass, right? Just based on the economic terms.
Management fees, people are generally understanding that you need them in order to get going in business, and that it's effectively, I've heard some LPs kind of claim it as almost as a loan that has to be repaid by the GPs to the LPs before their carry kicks in. And then on the other side of the economic timeline, carry and waterfalls, those can become quite easily accessible between managers. And if you're out of market or have a very aggressive carry or waterfall schedule, then that becomes very apparent to LPs very quickly.
American versus European waterfalls, like understanding again how cash flows through the business is super important. The expenses terms, right? Like not only what are you earning from fees to manage the business, but how are you expensing things to the fund, which
Yep.
effectively is your limited partners' dollars. I think those are again economic terms that are helpful for an LP to understand. Also, I know it sounds strange, like in venture capital world, but like debt, right? That's collateralized by the fund, and just making sure, right? There's again a fund formation lawyer to point number one that has properly written the terms and kind of properly structured this fund so that it's truly a venture fund, under kind of the historical expectations of a venture fund. Very important.
Can I ask you, in your experience now, looking at hundreds of LPAs, it seems like there's almost tiers of economic terms. Management fee, carry, how the waterfall works, as you mentioned, but then things like the ability to take on debt is fairly standardized. There's even government rules about how exempt reporting advisors can do this. The banks have all kind of seemed to find consensus in market. So it's like, do you do debt or not? It's less on the specific terms. And same with like things like accounting. Are you a 45-day reporting at quarter end and 90 at the year end, or are you 60 and 120? There seems to be kind of already consensus driven terms for some of these things that are kind of tier 2 economic terms, capital call timelines, those kind of pieces. Would you say that's been your experience as well?
100%.
Sure.
I think the big picture here, right, is the economic terms are going to be scrutinized,
Mm.
right? Don't do yourself a disadvantage as a GP by being too far out of market. Have that conversation with, your legal team, ask them their understanding of market, but also understand it from, peer GPs and again, what the market is willing to bear. And there's a spectrum here. There's a place where I've seen GPs charge almost too little, where it makes it hard to build a business. There's kind of what we're calling like the market standard. And then there's, another part of the spectrum, which is starting to slip into egregious potentially, right? Where the
Mhm.
fees are clearly too high, they're off market, they're non-standard. And I think that's when you start to get, a lot of scrutiny that could lead to a pass or a lot of feedback and negotiation. And again, one of the big takeaways from this whole call is like trying to help you think through some of these issues so you can save cost upfront. And if you start out with non-standard terms, which leads to negotiation, that's just going to, again, it's going to increase your costs of setting up a fund, which is not what we're not trying to encourage.
This is also one of the key areas I see negotiated inside letters, right? And so there's often other areas we may talk about here in a second that are inside letters that are kind of unique or specific to an LP. But generally, when I see side letters, they talk about the economic terms: carry, management fee waivers, carry reductions, other things that are germane to them. But a lot of it focuses around the economic pieces.
Yeah, great segue. I think the last bucket, maybe you could call this a catch-all, but it's, other terms. It's the, esoteric terms. So a point of view on what else are LPs evaluating during an operational due diligence process within the LPA. These can be economic, but, there can be other takes and other terms as well. So I feel like I've taken the role of the interviewer in this particular episode, but Dave, walk us through a couple of these esoteric terms.
Yeah, I mean, definitely one of my favorite ones that I see often in side letters, and sometimes even in LPAs, are expense restrictions around first class travel or expensive hotels. And so often you'll see some of these esoteric terms come as a result of an LP having had a bad experience with a GP in the past. And so sometimes they're very specific to things that GP can or cannot do. They'll often be associated with the types of LPs. So you may have LPs that have ERISA requirements, and there's certain tax considerations that they must adhere to. And you've kind of agreed by taking them on as an LP that you will invest in the types of investments that are beneficial in that kind of ERISA schemes, right? So it's just making sure that you're aware of what's important that is not already covered in other pieces. So often see things like how GP's key time will be spent on the fund, especially if the GP is a celebrity or famous or has multiple businesses going at one time. And you often see language around the advisory committees come into sections that we would not normally call, or that we would call kind of the how the fund works in the background kind of section. So yeah, I see a lot of different terms and expectations, but it usually is something specific that an LP is responding to a bad experience or a good experience they previously had.
Yeah, I think maybe 2 or 3 more terms, like one around like economic around distributions. So
Mm.
if there is a realization, how is that handled? How much
Yep.
flexibility does the GP have? And sometimes the LP may want more specificity there. Another term that can come up is to Dave's point around business time and understanding who's going to be spending time on the fund. Who are the key people, right? Historically called key man risk or the key man clause, now called the key person clause. Really understanding, who is, I guess, indispensable to the fund. Very important, right? Because LPs have to bet. They're like seed investors. They have to bet on a team. Sometimes before there's any data behind that, team or strategy. So again, very important terms. Call it again the general bucket of there's going to be other terms that just to be aware of and be prepared for that LPs are going to be digging into, right? And there's usually a really good reason for, why they're asking about those terms or why they're negotiating on those terms.
And I would say as you're going through this, both with your counsel and with your anchor LPs, usually are your largest investors, you're almost thinking kind of in chess. If I negotiate heavy on this topic, what are they going to negotiate? If I give them something that is meaningful to my LPs and less meaningful to me, can I ask for something in a different area of the LPA? I often see GPs kind of weighing the different things they care about versus their LPs. And I think it's an important thing to do with your counsel, with your mentor, is kind of figure out how to build a deal where you can make your LPs happy on the things that they must have or are really important to them. And definitely the economic terms, the structural terms, and even some of these esoteric terms that fall into those buckets, but also make sure that you're balancing that. And if you need, the economics to work in your favor for management fees, you're able to do that comfortably in the negotiations by kind of giving and taking. So I often encourage people to think of all these terms holistically together and then pick and choose which ones they really want to fight for and which ones they're very comfortable kind of giving a little bit on.
And again, we've tried to characterize this as, GPs have to set up their fund. They have to think about legal terms. LPs are going to be evaluating them, on the basis of these terms and where they sit with respect to the market standard. And just, one thing to think about is the LPA is subject to change, right? You can add in amendments. It's not super common, but it does happen. And there's also, side letters, which Dave alluded to. So there's ways in which you can add and adjust the LPA. The LPA at inception is kind of the best foot forward in terms of the contract between the GP and the LP. And hopefully today's episode helps you think about negotiating the LPA, setting up these legal terms through the lens of these 5 buckets.
In this episode's Did You See, I think we should mark a moment and talk about the Coolwater Investor Summit that we had this fall. We had a bunch of managers come together, and both panels and investors gave pitches on what's happening in their parts of the market and what are the conversations in firm building. So Winter, it was your demo day. Why don't you kind of share with us some of the big themes that the panels were talking about?
Yeah, I think we'll touch on 2 points. I think the first point is how many people say, VCs are great at investing into innovation, but they're not innovative themselves. And so one of the big themes I think that carried through several panels was how GPs build on the back end, right? And what they're doing now in terms of their own, kind of AI building at the firm, internal to the firm. So I thought that was a really interesting theme. And I think another theme came through and shined through, with the pitches, which was, managers that are successfully raising in today's fundraising environment have very clear stories, very simple, differentiation. And I think that's what's driving fundraising dollars in today's market. So I know a lot of people say like, hey, a lot of dollars going into AI. But again, there's a layer deeper there of like, why are certain funds in AI raising more and why are certain funds targeting AI raising less? And I think it comes down to, again, the thesis and like the very clear differentiated strategies of funds that have access to specific networks or, have a track record betting on certain very, specialized types of companies. The simpler you can be, the more kind of N of one you can be in these categories. It seems like that's what's really driving fundraising dollars today.
Yeah, so I mean that definitely came across as a member of the audience listening to some of the managers present. You can hear the ones that truly understand the ecosystem, and I'd say in the case of AI, many of the managers were actually sharing the stories of themselves touching the metal, so to speak, and coding and vibe coding and building along with the founders. And I think it's interesting to see those managers so excited about the tools themselves as well.
Great. We'll see you next week.
All right, see you next week.